All right, welcome to The Explainer. Today, we're diving straight into a really fascinating collision. On one side, you've got the classic, enduring American dream of homeownership. But on the other side, we're looking at the incredibly complex and honestly, sometimes harsh economic realities of the year 2026. We're going to break down KB Home, one of the absolute biggest home builders in the nation, and look at exactly how they're navigating a post-pandemic housing market where that golden age of ultra-low mortgage rates is firmly in the rearview mirror. So this isn't just a story about laying bricks and building houses. It's a massive story about financial engineering, margin pressures, and adapting to survive.
Here's a quick roadmap for us today. We'll be looking objectively at 5 key areas: the American Dream Builder, sustaining the future, the shareholder value engine, the margin squeeze reality, and finally, the 2026 outlook.
Okay, let's dive into Section 1, the American Dream Builder.
To really get what KB Home is all about today, you kind of have to look at their roots. They've got a near 70-year legacy, and their entire brand purpose is built around expanding access to the American dream, specifically for the first-time homebuyer. And they are doing this at a staggering scale. I mean, they currently operate across 49 major markets in 9 states, from the West Coast, straight through Texas, and all the way over to Florida and North Carolina. They very deliberately target these markets for their long-term economic and demographic growth. They aren't some niche boutique builder, they're a massive volume engine. But the real question is, how do they keep it affordable in 2026?
Well, the answer lies in their highly distinctive built-to-order business model. You see, unlike a lot of builders who just construct dozens of speculative homes and sort of cross their fingers that buyers show up, KB Home completely flips the script. Buyers choose their lot, their floor plan, and their specific design features first. And why does this matter so much to us as analysts? Because this specific model is literally their frontline margin defense. It calibrates home sales rates and selling prices beautifully, ensuring customers are only paying for the features they truly value. And that is exactly what allows KB Home to keep thriving and holding on to profitability, even without the artificial boost of those ultra-low mortgage rates we were seeing just a few years ago.
Let's move right along to Section 2, Sustaining the Future. Now, what's really interesting about this slide is getting a buyer into a home, that's really only half the battle. Keeping them there affordably is the other half. Just look at the sheer quantifiable impact of their green initiatives. We aren't just talking about feel-good PR here, we are talking about hard economics. By 2025, they had delivered over 217,000 Energy Stars certified homes. Their national average home energy rating system, or HERS score, was 43, which is actually one of the lowest among national builders. Because of this high-performance building, they've conserved roughly 2.3 billion gallons of water annually and helped homeowners save an estimated $1.3 billion cumulatively in utility bills. A highly efficient home literally lowers the total cost of homeownership month over month, which feeds directly into their whopping 96% customer satisfaction rate.
And you know, this philosophy is baked into the company culture right at the very top. As Executive Chairman Jeffrey Mesger and CEO Robert McGibney put it perfectly, building sustainable homes and expanding access to homeownership are not competing priorities, they are one and the same. They have successfully managed to culturally and, more importantly, financially link green building directly to baseline affordability.
All right, shifting gears a bit for Section 3, the shareholder value engine. So we know they're building efficiently for the consumer, but what about the investor? Just look at that number, $1.9 billion. That is the staggering amount of capital KB Home has returned to its stockholders through repurchases and dividends since the second quarter of 2021. They've consistently led their peer group in return of capital yield over the last 4 years. Basically, they've turned into a cash-generating machine, and they absolutely haven't been shy about giving that cash directly back to the folks holding the stock.
And this brilliantly illustrates exactly how they've engineered that value over the last few years. Through massive $1 billion share repurchase authorizations, which, by the way, they just renewed again in late 2025, they have literally shrunk their share count. Back in 2021, they had almost 95 million shares outstanding. Fast forward to Q1 of 2026, that number absolutely plummeted to just 62.6 million. They repurchased nearly 37% of their outstanding shares. It's like taking pieces of a pie off the table, which means the remaining slices get much, much bigger for the investors who hold on.
And the direct result of shrinking that denominator? Boom! Their book value per share skyrocketed to a record $61.53 by the first quarter of 2026. This aggressive, masterful capital allocation strategy is exactly why Wall Street institutional heavyweights like Vanguard and BlackRock maintain such high ownership levels in the company.
But it's time for Section 4, the margin squeeze reality.
Okay, there is always a but in economics, right? We have to execute a pivot here, because the undeniable truth is the golden age of housing has ended. Financial analysis platforms like Simply Wall Street have started sounding the alarm, outlining a very specific bear case for 2026. They are pointing to softer revenue and shrinking net margins. But the real glaring cautionary note is about durability. There are growing concerns that KB Home's operating cash flow might actually struggle to sustainably cover its debt if they are forced to start heavily increasing buyer incentives just to move inventory in a cooling, more cautious market.
It creates this really stark contrast between their product and the macroeconomic environment. On one hand, you have these pristine, highly customized, built-to-order interiors that buyers absolutely love. But out the front door, you have the ugly reality of macroeconomic forces. We're talking about soaring construction material costs, persistent supply chain friction, and crucially, skyrocketing wildfire insurance premiums in huge key markets like California. These external costs are aggressively eroding the very affordability KB Home is working so hard to deliver. It's gotten to the point where they're having to pilot new, rigorous, fire-resilient design standards just to ensure their buyers can even get insurance in the first place.
Which brings us to our final stop, Section 5, the 2026 Outlook.
Let's see how this all builds up, because right now the financial world is entirely split on what KB Home is actually worth. Just look at this massive disparity. On one side, the major investment banks are feeling cautiously optimistic. They see those incredible share buybacks, the strong balance sheet, the defensive built-to-order model, and they've set a consensus price target around $85 per share. But on the flip side, you have bearish models, like the fair value estimate from Simply Wall Street, sitting all the way down at $35 per share. They are hyper-focused on those shrinking margins and potential cash flow struggles. It is a classic, textbook battle between historical capital efficiency and future operational fees.
Which leaves us with this final, incredibly provocative question for the year ahead. Can their new CEO, Robert McGibney, successfully navigate this immense macroeconomic balancing act? He's tasked with protecting investor margins against a rising tide of regulatory and environmental costs, all while somehow keeping the price tags low enough to actually deliver the American dream to first-time buyers. Honestly, it is one of the toughest tightropes in real estate today, and how KB Home performs in 2026 is going to tell us a whole lot about the underlying health of the broader U.S. housing market. Thanks so much for joining me on this explainer. I really hope this helped you structure your understanding of the incredible forces at play here. See you next time.